Hello and welcome to another financial analysis video with myself, Moeed Amin, and Ted Wainman. Today we're going to be looking at Aldi, which is a large discount large multinational discount supermarket chain. That's a bit of a mouthful there. So the goal, as ever with this show, it's an education show, and we're here to help you improve your business acumen. And as Warren Buffett said, if you want to understand business, you've got to get to know its language, and finance is the language of business. So on this show, we're going to be going through the financial statements of very well-known and very famous businesses to help you more confidently and quickly and more accurately analyze the financial statements of a company and draw out some interesting insights and conclusions about the business. So when we're looking at Aldi today, now, although they're a German multinational business, they're actually owned by the Albrecht family and their heirs. So because it's a private business, we're not able to get the finances of this company. In fact, they're not public, and therefore we can't see any share prices. However, because they have a UK business, in fact, they're present in 20 countries and have around 10,000 stores. Because they're based in the UK, one of the quirks of the UK business system is that any company over a specific size, namely more than 50 employees, 5 million pounds in assets, and certain level of revenue, if they qualify for two of those things, then they have to actually publish their finances and their reports on what's called Companies House, which is the central ledger for registering a company. So we're going to be looking at Aldi UK as a business, but bear in mind, it is an international business. It's founded and based in Germany, but we're just going to be looking at the UK business. So this company, was this company a request, Ted, from one of our viewers?
Yes, it was.
Yeah.
We've got two people have asked for it.
Great. So Nick and Bumi, this is your video. And for any of you watching this, you can also make a request for companies that you would like us to analyze. In fact, I'll say about 98% of the companies we post out on here are actually from recommendations or requests from you, the viewers. So if you can put your request in the comment section below, add some context as well, because the more interesting the context, the higher likelihood we're going to push you up that priority ladder and publish your videos sooner. So do make that request. So we're not going to look at share price today because I said it's public. So we'll just jump right into the finances and let's see what the finances say about a company like this.
Good to see you, Moeed. Thank you very much. Welcome to all of our viewers. Welcome back to our subscribers. If you are not a subscriber, then please hit the subscribe button, bottom left-hand corner. No, right-hand corner, I think it is. Anyway, bottom left-hand corner as I'm looking at it, bottom right-hand corner as you just hit the subscribe button. Don't forget to like and share as well. So let's jump in and have a look at the finances. As Moeed mentioned, this is a publicly available document. It's on Companies House, and this is just looking at the UK operation. So this is Aldi Stores Limited. It's just the UK, which is one of, as we mentioned, 20 companies in the 20 countries in the sort of the Aldi family. So we're not looking at the whole company. So we'll whiz straight through into the actual financial statements, find out what is going on with these guys. So here is their income statement. And we start off with dealing in pounds. We are in thousands of pounds, year ended 31st December 2021. So turnover is 13.6, that's 1,000 million, so 13.6 billion. So here in the UK, Aldi is turning over 13.6 billion and the cost of sales is 13.3 billion. So on a 13.6 billion turnover, they're making a gross profit of 346 million pounds. That's 3%. Okay, so these guys really are a discounter, and they are making very, very small margins. So if you go in and you buy a bunch of bananas for £1 for these guys, it probably costs them about 97p to buy those bananas. Okay, so they really do operate with incredibly tight margins. We've then got the administrative expenses. which is 303 million pounds, leaving them with an operating profit of about 60 million. Small a revaluation on a property there, but operating profit 60 million, which is effectively 0%. And then they are paying interest here, so there's interest and tax that leaves them with effectively next to no profit at all. Okay, so £5 million profit on a 13.6 billion pound turnover is basically break even. Even in the previous year, they were making a turnover of 13.5 billion, sorry, and only 202 million pound profit. So quite interesting that these guys, you know, so there is this tax that they're paying, and also this cost of sales. We just need to be a little bit careful about this. So this is very much the UK. Doesn't tell me where they're getting those sales from. Okay, now when we look at the balance sheet, we'll see that there are some intercompany accounts. So it's quite possible that, for example, if they, you know, you want to buy, I don't know, let's say a packet of coffee, for example, what they could do is be buying that coffee from somewhere else in the group outside of the UK, and if they charge a lot for that coffee, effectively it's a way of moving profits out of the UK into potentially a lower tax jurisdiction. So for example, tax is much lower than Ireland, and so you really want the profits to be arriving in Ireland and not in the UK, so you pay less tax on them. Okay, so when we look at this kind of break even and we think, oh gosh, you know, Aldi is obviously, you know, an absolute bargain, we don't get the full picture, and that's why we tend to like to see the group accounts rather than individual company accounts, because it gives me, you know, it's the way the group transacts with third parties outside and doesn't reflect how the group transacts with itself within the kind of the Aldi family. Okay, so there's our sort of caveat. Second one is we might just want to just double check this. So you know, not often that you find companies within a group holding debt, and obviously these guys must be holding debt because they're paying interest, and so again that's a way of moving money around. So if that loan comes from a group company rather than third-party bank, then the group company can charge interest, and a way, again, that's a way of extracting profits or extracting money out of this company into somewhere else within the group. Okay, so just a couple of highlights there. Let's go and have a look at the balance sheet. So the balance sheet, you know, lots of tangible assets. Now they're gonna lease their stores. I would expect them to lease their stores. They may own the stores. They may own the land, for example, and certainly the fixtures and fittings. 4.7 billion is quite a lot of fixtures and fittings, suggesting that they do actually own a lot of the stores as well. Inventories, so that's the kind of the stuff on the shelves, you know, that'll be pretty fast moving. You know, if you take about 500 million of inventory and compare it to your turnover of 13.6 billion, it's telling me that on average they're selling stuff within about 14 days, and that's about average for a supermarket. You know, the lettuces and the milk will go a little bit quicker, and maybe the wine and the clothes and the, you know, the other stuff that they sell, you know, maybe tins of baked beans will go a little bit slower, but 14 days sounds about right. Trade, their debtors, and we'll look at the trade, we'll look at the debtors in a little bit more detail. So we're going to look at these notes here in order to find out a little bit more about these numbers. So the debtors is note 15, and the creditors, the current liabilities, is note 16. So let's just have a quick look at note 15 to see what is contained within the trade and other debtors. We wouldn't expect a lot of receivables, trade receivables from third parties, because if you think about it, you know, when you go to Aldi, when you do your shopping, you pay before you leave the store. So we may have that. This could be a little bit of that, but otherwise really very little. Maybe there's kind of credit card. It takes them a couple of days to process the credit card. So what we do notice here is that a significant amount is amounts owed by group undertakings. Maybe they've been selling to other parts of the group. So again, we can really say that, these guys, their debtor days, the amount of time it takes them to collect the money in is effectively negligible. And then from their creditors, we've got this trade and other payables. So this is from third parties, and then the amounts owed to group undertakings. Now, that amount owed to group undertakings, to me, looks like that the purchases of those goods, they're buying stuff from third parties. So here in the UK, some of it will be within the group, but most of that cost of sales looks to me like they are buying from third parties just by the relationship between those two numbers. And if we take that 1.3 billion, it suggests that they are paying in 34 days. So these guys, their stock is sitting there for about 14 days. They're getting the money almost immediately, and then they are paying their suppliers in 34 days. 34 days, pretty good. So if you're a supplier to these guys, looks like they're pretty prompt payers. And that wouldn't surprise me if, as a discounter, they really need to keep their suppliers on side because they know that they are squeezing their suppliers down as much as possible on the price. So 34 days. So with this 34 days, effectively the difference between 34 days and the 14 days is 20 days, and that's 20 days they're getting the cash in before they pay the cash out. Many businesses, it'll be the other way around. Now, this is very important for a supermarket such as Aldi, because this is crucial to their cash flow, and because of that strong cash flow, what it means is that if we go back to the balance sheet, we can find it, here it is. So the balance sheet, many of you will kind of be going, oh, hold on a sec, look, the current assets are here. That's actually here we go. We want to be looking at the group. So the current assets here are 873 million, and the current liabilities are 1.6 billion. And many of you will be sitting there thinking, hold on a sec, that's a current ratio of 0.53. Ding-a-ling-a-ling, alarm bells. There's liquidity problems, but people like telcos and supermarkets can operate at that low, current ratio because of their business model, because they get cash in before they pay cash out. And whereas most businesses are paying cash out to suppliers and to their staff, and then collecting the money in from their customers. So that's why these guys are able to operate with what we call effectively negative working capital, this net current liabilities. They've got a little bit of liabilities of amounts falling due after more than 1 year, and a bit of a provision for liability. So, reasonably strong a balance sheet sitting there of about 3 billion. So nothing really kind of shocking in terms of the balance sheet. And obviously, if they do run out of cash, if they do become a little bit struggling, then you'd expect the group to step in. They're not just going to let these guys go to the wall. The equity, how they funded, so 1 billion of investment and about 2 billion of retained earnings. So profitable, and keeping that profit in the business. We can see the movement in equity here, and again, this will be kind of, don't forget that this is not you as a shareholder of Aldi. This is their relationship with the group company sitting in Germany. So when if we do see any dividends, then it's really just returning that money to the group company, the head office. No dividends going on. And so really, they're just keeping all the money. It's all being reinvested back into the business. So last one to look at is the cash flow. Here's our net cash flow from operating activities. They do the reconciliation. Most of our cash flows we've been looking at on these series, they show this reconciliation from the profit to the cash actually on the cash flow statement. These guys under UK GAAP, you can put it in the notes, and we can have a look at there is that note. So there's the profit for the financial year. That's the profit figure we found on the income statement, and there's the cash generated. A couple of big numbers. Depreciation. So depreciation is a non-cash expense and is therefore added back. And this is a quite an important part here. So this is our movement in working capital, and you'll notice that their inventory has gone up, so they've got less cash. The amount that they are owed by their customers has gone up, and so they've got less cash, and the amount that they owe their suppliers has gone up, so they have less cash. But really pretty small numbers in comparison, so that's not really a sort of a massive material. The most of it is on the increase in inventories. Rest of the cash flow, so as we'd expect for a company like this, pretty straightforward. So they're investing in the business, 500 million, so that'll be buying new stores or fitting out new stores, selling bits and pieces that they don't need anymore, so net 475 million of investment. And then in the financing, you'll notice here we've got some net payments to group undertakings. Okay, so and then loans advances from group undertakings. So again, just to remind ourselves that when we looked at the balance sheet, we saw this amounts falling due within 1 year. We want amounts falling due after more than 1 year. So note 17 is telling us about the long-term funding in the business. If we whiz down to note 17, we can actually see where those loans are coming from, loans from group undertakings. Okay, so this is the head office has lent these guys 880 million. Their agreed market rate of interest, and so in effect, this is a way of extracting money from the Aldi UK. Now, this is important. We need to kind of understand this. Because if we go back to the income statement, sorry about all this whizzing backwards and forwards, but if we go back to the income statement, this is known as the tax shield, that if the group company lends these guys 880 million, they will pay interest. There's the interest. The more interest they pay, the less tax they pay, because the tax is effectively calculated on this number here. Okay, now that's a high relationship. So you kind of think, oh, hold on a sec, if I make a 35 million profit before tax and then I get taxed of 31 million, so there'll be other adjustments going on in there too. But as an essential rule of thumb, the tax you pay is calculated on your profit before tax, and therefore the more debt you have, the more interest you pay. The more interest you pay, the less profit you make. The less profit you make, the less tax you pay. And so in effect, this is a way of the head office extracting money from these guys. So rather than having the dividends, which are paid out of post-tax income, they are lending money and receiving interest, which is paid out of pre-tax income. So this is a tax shield, and this is obviously benefiting the owners of the business. So there we see in the cash flow. Go back to our cash flow. So there's a little bit of loans and advances to group undertakings, etc., etc. And that is giving them an extra 290. So if we have a company who they're generating 177, they're spending 475, and the sort of difference is 290, which effectively means that their cash has gone down very slightly during the year by about 6 million. They start with 110, goes down by about 6 million, bit of exchange rate, and they finish with 103. So they got plenty of cash, 100 million sitting on their balance sheet. So as we said, Moeed, there's no balance sheet. There is a balance sheet. There's no share price there, because this is a private company. So we don't have to sort of comment about the share price. But what does it say to me? These guys, they are, they're incredibly tight in terms of their margins. It looks like that, what you pay is, effectively what they pay. They're making very, very small margins. They are profitable. And they are probably making a little bit more profit at the head office than they are at the UK level. That's going to be very tax efficient. And if you think about recent developments where people are talking about increasing corporation tax in the UK, then there's an even bigger incentive for people like Aldi to extract money before that tax and pay as little tax as possible in the UK. And we see that in other companies as well, certainly in the water companies here in the UK. Water companies typically have a lot of debt. They're paying a lot of interest, and because they're paying a lot of interest, they're paying absolutely no tax at all. They're not paying any dividends because they're making very little profits, but the profits are coming out through interest payments and not through the dividend payments. So always worth just being aware of who is lending money to these companies.
Yeah, and that there you have it. That's very interesting, and that's why we always like to look at the group company finances if you can, because that gives you a better indication of a few things like actually gross profit. You know, where are they buying supplies from? How are they doing that at a group level? But this is a great example of a company that's effectively lending money to itself within the group and buying things from each of the subsidiaries within the group as well. So this is a great example of that. In fact, we have, and Ted mentioned water companies, we actually have looked at Thames Water, which is a well-known water utilities business in the UK. You know, you can search for the for that video in the playlist. So until the next video, thank you, Ted. Thank you, everyone. Don't forget to like, share, subscribe. And of course, if you are really interested in a company that you would like us to analyze the finances for, do leave a note in the comment section with some details about why you are interested in that company. So until then, thank you. We'll see you in the next video.
Good to see you, Moeed. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please, please, please don't forget to like, share, and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions. And do recommend any videos, any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up. So please do take the opportunity, have a look at the other videos, and don't forget to like, share, and subscribe to the channel. And I will see you on the next video.